I'm Ben Yearsley, Investment Director at Wealth Club, and I'm joined today by Ben Guest, Managing Partner at Hazel Capital. Good morning, Ben.
Morning.
Can we just first start off by you explaining who Hazel Capital are?
Of course. Hazel Capital is an FCA-registered fund management firm. I founded the firm in 2007, so getting on for 10 years ago, and we're completely focused and dedicated to creating investment opportunities for our clients in the renewable energy space.
So you have been known largely for things like VCTs
Yes.
and a bit of EIS,
Yes.
but we're not talking about those today. We're talking about some power bonds, as you've called them.
Mm-hmm.
Can you just explain what your power bonds are?
Absolutely. I'll start by giving you a little bit of background. There's been a very interesting shift as a function of the renewable energy evolution or burgeoning sector. And that is the changing mix of power generation in the UK. We've seen a decline, particularly in coal-fired power plants, and the increasingly rapid decommissioning of those, or scaling back of their output, and an enormous increase in the amount of solar and wind generation that exists in the UK. As a result of that, you've obviously got a far more intermittent mix of power. But there is another feature as well, which is even if we were dealing with a normal or historical scenario where we were largely driven by base load plus peaking plants as opposed to intermittent renewables, there would still be the need to balance the frequency and voltage on the grid. National Grid has an obligation, naturally under its license, to maintain the frequency of the grid at or very close to 50 hertz. That's historically been done by large power plants, and still is done by large power plants, simply, in very simple terms, revving up or down to instantaneously meet the power requirements on the grid. As they decommission, their existence disappears, and the ability for that kind of plant to provide that service to National Grid also disappears or reduces. As a result of that, National Grid are open to alternative ways of meeting their balancing requirements, as they call them. And this project for which we're raising the power bond is precisely one of those projects. And about 70% of our revenues for this project will come from already contracted revenues to meet such a demand.
So, investors, our clients, are putting up money into the power bond.
Yes.
What is the power bond then? What are they lending to, and then what is that lending to?
Indeed. So there is a project company that will build and own the project. It's actually a relatively simple project. It's a 1 acre site. Solar farms are typically 25 acres. That's historically what we've done, all bigger. This is a simple 1 acre site with a combination of batteries and engines in it. The project company will own that. To simplify things, actually, even though it sounds a little bit more complicated, we've created a funding company into which all the different kinds of funding, the majority of which is from the power bond, come into. And then once the funds are aggregated, they are then lent on to the project company. And then all the cash flows from the project company until the power bond is fully repaid. One of the, I hope, interesting features for investors is that no other lender or shareholder in the fund company, or fund co as we call it in the offering memorandum, receives a single penny until the power bond is fully serviced and fully repaid over that 2.5 year period.
So where, you've probably already said this in the answer to one of the earlier questions, but just precisely where does the money come from to then repay interest and capital to investors lending money via the power bond?
Indeed. So as I mentioned, the frequency response service that we provide to National Grid is approximately, because it varies by year, depending on the other services, and I'll come on to those, approximately 70% of revenues. And then there are two other forms of revenue. One is providing again, National Grid, a supply of power during the very, very peak moments of power demand in the year, in order to make sure that those very extreme peaks are not too high. National Grid imposes very high electricity charges in what they nickname or call net transmission network use of system charges, or nicknamed triads, because there are three of them, and they set very, very high prices during 3 half-hour periods during the year. And if we supply power during that time, we are making sure the National Grid, which is in inverted commas glowing red hot at that point in time, it's seeing the most power it sees all year long, we're avoiding or helping avoid any blackouts should there be a tight supply-demand scenario. And some of the charges that are charged to mainly industrial users during those peak times flow through to generators such as us, and so we earn substantial revenues from that. And then finally, at the start of, or a little after the start of 2019, there's a third contract which actually runs for 15 years called the Capacity Market Contract, which is another availability service, but which is to provide at fairly short notice, but not instantaneous notice, if you like, as is the case with frequency response, a service to National Grid to make sure that there is power available should there be a shortage. So we've got 3 contracts, frequency response for the majority, triads for the remainder for the first 2 years, and then from 2019 onwards, a capacity market contract which runs for 15 years.
So what's the level of risk for investors in this kind of they might be used to VCTs or EIS and things like that, where you have the tax break that helps underpin things.
Absolutely.
You haven't got this with your power bonds.
Yes.
So what kind of risk is there for an investor in this?
Starting with the contracts, these are availability-based contracts. We're not subject to fluctuations in any meaningful way to power prices. So we don't have to try and guess what the power price is going to be. We know the FFR contract, as long as we remain available and perform according to the contract, is a fixed price contract. Same goes for the capacity market contract. Triads are set by the market, but all we've seen so far is inflation in that market, and our projections in our model for our triad receipts, payment receipts, are well below the inflation expected in that market. So that's at a contractual level. There's a lot of visibility in terms of what we're going to earn, and there's no correlation to power prices. These are not subsidized projects either, so there's no regulatory risk of that nature either. In terms of should something go wrong, and we really don't foresee it, at the outset, at the installation phase, we're installing this project relatively quickly. We're basically installing boxes on a site and wiring them together, very simply put. The value of that equipment, the asset backing in the project, is very, very significant, such that the value of the equipment is greater than the amount of the power bond. We have a contract with an